Do you know that a successful IPO launch is like hitting a gold mine? Don't believe me? Then listen to this. Alibaba, the most famous Chinese e-commerce company, it raised a breathtaking 25 billion US dollars on the very first day of going public. It's a record that still holds. Finally, the world has found a substitute for gold mines, and that is IPO. And the best part is that you don't have to dig for years as you would do for gold mines. So is IPO the destination where all present companies and future companies are headed to? In this video, we'll discuss the nuts and bolts of an IPO. Hi all, my name is Dheeraj Vaidya from wallstreetmojo.com, the home for most authentic place to learn finance and accounting. Let's get started. First thing first, what is IPO? IPO, or initial public offer, is when a company actually goes from being a private company to a public company. And this is done by selling shares to the public. Now, who is the public? These are ordinary men like me and you. What this actually means is that earlier the company had only a small number of investors like the company's founders, the venture capital, etc. in the beginning, but now they are open to receiving investments from tens of thousands of people like you and me, as well as other shareholders. So now going public can actually take a lot of time, even months as well. But when the process is complete, you'll find that the executives actually throwing big parties or ringing the opening bell at the stock exchange too, right? There are different ways of celebration. Now let us look at how companies go for an IPO. I mean, it's not that any random company can actually raise its head and list itself in the IPO, right? So when a company actually decides to go for an IPO, it first seeks out for an investment bank. Investment banks like the JP Morgan, Goldman Sachs, etc. So now these investment bankers actually do a complete analysis of the company. They study their business models, they forecast their financials, and finally they come up with something called the overall company's valuations. Next, the company needs to file a registration statement with the SEC, or the Securities Exchange Commission. What is this statement all about? This statement includes the information such as the company's operations, finances, business model, etc. The final part is where the company, with the help of investment bankers, prepare a documented prospectus. This prospectus is actually distributed to the potential investors such as the large institutions and the wealthy individuals. This prospectus contains information such as company's performance, future prospects, etc. So now, let's say once the process is complete and when the company has a fair idea of its stock value, a date is set for the company to go public. And boom, the company lands in the stock exchange world. Now, how does a company know what stock value to set? Actually, the company management along with investment bankers do lots of road shows. What does roadshow mean? Basically, it means that they connect and invite lots of interested investors to get a fair indication of how many shares they are interested in buying and a tentative price. And after this roadshow, the company actually has a fair idea of how many people are willing to buy the shares, in what numbers, and a tentative price. So accordingly, they set the IPO price and the number of shares which each investor can get. So now the next question comes is, why do companies go for IPO? I mean, what's the use of it? The companies generally go for IPOs when they're looking for a bigger amount of cash to expand their operations. Another reason could be that they want to pay off their debt. I think one more reason would be that early investors and founders may want to profit from their initial investments, and that's why they want to go for an IPO. Now let us look at a very interesting example of a recent IPO, and that is of Freshworks. On 22nd September 2021, Freshworks actually became the first Indian SaaS business to be listed on NASDAQ. It was started by Girish Mathrubootham. He's the son of a retired bank officer. Girish actually built this $10 billion company in just 10 years. Freshwork raised $484 million in total funding from VCs like Sequoia Capital, Axel, Tiger Global, etc. Finally, Freshwork raised $1 billion in its IPO and created more than 500 crore-patis in India, with 70 of them under the age of 30. Prominent investment bankers like Morgan Stanley, JP Morgan, Bank of America were the ones who helped Freshwork with its IPO. Now, going public has many advantages attached to it. Think of it like this. IPO actually helps with the publicity part of the company, right? Which will eventually help the company with extensive customer base. Another advantage is that IPO leads to an inflow of cash, which the company can use to expand its operations or pay off its debt. One of the other advantages is that founders, early investors, or even employees who were given ESOPs of the company, right? They can earn a lot of money when the company goes public because it's like a liquidity event for them. I'm sure you must have heard about people becoming millionaires or even billionaires when their company goes public. However, the flip side is that public companies are under constant regulation of authorities such as the Security and Exchange Commission or the SEC. And with this, they have to file for the quarterly reports, the annual reports, as well as report any changes related to the management, shareholding, etc. Another disadvantage is that these companies, the public companies, are under huge market pressure because they are under constant scrutiny from the investors. If the company fails to deliver on the financial results, then the management or maybe the owner might even get fired from their own company. So what is the best time to invest in these IPOs? Or is there any? Now, it's a very difficult question to answer. However, let me try. Now, there are 2-3 things which you might consider. First, if you're looking at a short-term profit from trading, then you can definitely invest in these IPOs and reap the profits from the price increase on the very first day. But after that first day, you at least square your profits, right? However, if you are considering from a long-term investment plan perspective, in that case, you must do your proper research about the company, its cash flows, track records, finances, etc. And only then you should invest in the IPO. Another approach could be wait and watch. Watch for a few weeks, months, or maybe even few years where the frenzy has disappeared, prices are down. That's when you invest. A classic example would be think of Facebook. Facebook in the initial 3 years, the stock went nowhere. But after it came out of the slump, it's now at an all-time high. So these are the things which you can consider while investing in an IPO. So should you invest in IPOs? Investing in IPOs is actually one of the best ways to create your portfolio of investments. But do remember, just investing in IPO because it is hot and everyone is interested, it really doesn't make sense. You should do your own research before investing. And we have also seen and heard many stories that people have made fortunes out of these IPOs. However, with every market investment, comes a certain degree of risk. So putting your money in IPO also depends on how much risk are you willing to tolerate. I hope you found this video to be useful. Please do like and share. And if you have any feedback or want to suggest a topic for any future video, then you may do so by writing about it in the comments section. Also, we come up with very interesting videos on finance and accounting topics regularly. So if you haven't subscribed to our channel yet, please do so by clicking on the subscribe button below so that you can get the notification as soon as we release the latest videos. Thanks for watching. Have a nice day.